Thank you for taking the time to learn about LHA's Market State Alpha Index and the Bayesian statistical techniques used to interpret the changes in market return of the S&P 500 over time. This presentation is a refresher for some and perhaps valuable new information for others. In a nutshell, the LHA Market State Alpha Index monitors on a daily basis the changing return distribution of the S&P 500 and employs well-understood Bayesian statistical techniques to interpret the meaning of these changes over time. We will look at a series of charts now, but first, let me orient you a bit. This is called a distribution chart, and it describes the distribution of the daily return of the S&P 500 over the 10-year period 2007 to 2017. On the bottom of the chart are bins representing the return of the S&P, incrementing by 20 basis points for each bin. Right of center are positive returns, and on the left, negative returns in the same increments. On the left vertical side of the chart is a scale representing individual trading days during the 2,518 trading days in the 10-year period. For example, the market achieved a daily return in the 2% to 2.2% bin about 10 times between 2007 and 2017. While it is convenient and intuitive to look at a chart like we just did, statistics looks at the mathematical description of a return distribution in the form of the 4 time-varying moments of a distribution, that is, mean, variance, skew, and kurtosis. The first moment is mean, which is simply the average return, in this case over the 10-year period. You will note that the average return during the 10-year period was 2 basis points per day. Of course, mean only tells you the average. Variance, also known as standard deviation, adds another important element to distribution analysis and is indicative of how much the market deviates away from its mean on a daily basis. Closely related to volatility, standard deviation is one of the most basic ways to measure the risk associated with an asset or portfolio. Another important gauge of an asset's volatility is skew, which is a measurement of the symmetry of a distribution around its mean. If a distribution is not symmetric, then it is either skewed left, negative skew, or skewed right, positive skew. The term left tail risk refers to a negative skew or a more pronounced tail on the left side of the mean, which alerts investors to a higher probability of negative returns. In other words, an asset with a distribution skewed to the left is much more likely to experience a drawdown than a symmetric or skewed right return distribution. Generally, negative skew signals a higher probability of losing money on a given day in a market regime. While the visual looks like skew is positive, the math says it is negative. Note that the left tail has a meaningfully greater number of large daily losses, 17 versus 9 large daily gains. This is an example why the math means more than simple visual observation can suggest. Kurtosis is a critical measurement and adds significantly to the mathematics of the interplay between the 4 time-varying moments. In nature, there is no such thing as a free lunch. Research suggests that fat which has been liposuctioned from one part of the body will return within a year. It just moves to a different place in the body. Note in this chart that there is increasing concentration around the mean, or the peak. Kurtosis is the measurement of the peak, which could be interpreted visually as offering less volatility and perhaps decreasing variance. But the math says that the tails have actually swollen, in this example demonstrating a fattening left tail, thus increasing left tail risk, all the result of a 300% greater value than in normal kurtosis. This chart shows the value of all 4 time-varying moments in this distribution of return over that 10-year period. But the more important statistical analysis in determining current market state is the more shorter-term dynamics. Now we will look at a more relevant period, a moving 6-month window into the changing shape of the distribution. Imagine a moving 6-month window, eliminating the oldest daily return and adding the newest daily return in the S&P 500. As you can observe before I start the video, in the first half of 2007, there was significant return on the right side of the distribution. But look at the outlier on the left side of the distribution, representing a single-day negative return of 3.6%. That was in May 2007 and has been called the knock on the door. The question at this point in the cycle is, why in the world would an investor want to be invested in this market state? In retrospect, there was generous warning of the gathering storm in 2007, but the rich returns that preceded 2007 and into early 2008 made people complacent. In hindsight, it was really unfortunate to be 100% long 100% of the time during the entire period described in this video. The LHA Market State Alpha Index uses Bayesian statistical techniques to calculate the probability of a change in the S&P 500. This probability value represents a confidence factor that governs allocation and thus net exposure to the U.S. equity market. Bayesian statistical techniques were first described by Thomas Bayes in 1763. Today, the same fundamental implications of Thomas Bayes' discovery have been advanced and are used in the fields of science and engineering, in weather prediction, voice recognition, spell check technology, among many other everyday applications. Unlike factor-based quantitative programs that tend to work until the factor or factors are no longer relevant due to over-adoption or a market regime change, the LHA Market State Alpha Index and other market state indices learn and thrive on changing market states. The LHA Market State Alpha Index is calculated and maintained by S&P Dow Jones Indices and is updated daily. It was launched in August of 2017, and the index provides back-tested performance calculated back to January 1, 2003. This index uses the 4 moments of return distribution in the SPY ETF and the Bayesian techniques described in this presentation to allocate to SPY between 200% long and 200% short the S&P 500. A private managed account has used the same allocation parameters as found in the index for over 4 years. The net exposure range of the LHA Market State Alpha Index may be readily calibrated by simply truncating the allocation percentage to whatever range is desired. S&P Dow Jones Indices also calculates and maintains a constrained version of the index, which reduces the net exposure to between 0, out of the market, and 160% long the S&P 500. This is called the LHA Market State Tactical U.S. Equity Index, and its back-tested performance also has been calculated back to January 1, 2003. Now, please take a moment to review the disclosures and disclaimer page. For further details on either LHA index, please contact Little Harbor Advisors.